Hello, ladies and gentlemen. I'm Casey O'Rourke with Frost & Frost Wealth Management, bringing you this week's economic and market update on Monday, November 15th, 2021. As always, please remember to take a look at those disclosures attached within the email. If you're on social media, please go to www.frostandfrost.com. So our little friend inflation is in the hot seat. If you asked anyone what they're most concerned about regarding financial matters, we believe the overwhelming majority would say inflation. Last week, both the Producer Price Index, PPI, and Consumer Price Index, CPI, both measures of inflation rose above expectations and hit highs we haven't seen in decades. Behind the rise in numbers are rent, wages, auto prices, and energy costs, among other things. While inflation may be running hot at the moment, we believe it's temporary. This week, we'll take a deeper dive into inflationary pressure that we see currently, what's behind it, and how long we think it might last. So, in a nutshell, higher prices. The CPI, an inflation indicator, has been above 2% for about 8 months, whereas in the 10 years before the pandemic, the average core CPI was 1.8%. Last week, the core CPI came in at 4.6%. We believe this to be purely pandemic-driven based on a combination of things happening simultaneously. Since the economy reopened, demand has been very strong, while supply chain issues have caused labor shortages and bottlenecks in getting goods to market. We also see commodity prices increasing. Think about that, over $3 per gallon at the pump. All of this has created an imbalance in the economy, causes prices to increase across the board, like things like clothing, groceries, including gas. So when will we see easing of the inflationary pressures? That's I think the number one question. And while we're in the midst of elevated inflation at Frost & Frost Wealth Management, we believe to think that these pressures will ease by mid-next year. That's yet to be seen. Remember, inflation isn't just one thing. There are at least three sides to the inflationary coin, and those can be broken into short, medium, and long time frames. So let's start with short-term inflation. When we talk about the short-term effects of inflation, we're talking about those price increases we tend to see pretty quickly after the start of an inflationary period. These are things we mentioned earlier, like gas and energy prices, the cost of food, lodging, and cars. These sectors have a lot in common that cause them to be affected by inflation quickly, but they also are sectors that normalize quickly as inflation comes down. Three things drive the rise and fall of prices: supply chain disruptions, labor shortages, and higher demand. I think we could check all of those off the list, and it explains why the price at the pump has gone up so much, and a $20 shirt is now $25, and your grocery bill went up significantly. So this can all be very discouraging, but remember, they are short-term in both directions. The rise in prices we have seen this year is not likely to continue. We also expect supply chain issues to begin easing next year, and we already see signs of this from the auto industry through quarterly earnings reports. And as we look at medium-term inflation, the factors of inflation that might not get better as quickly as gas or grocery prices tends to be things like rental costs, housing costs, medical care, and education costs. Wages also belong in this bucket as well, because once wages increase, businesses can't just turn around and reduce paychecks to help ease inflation. Medium-term inflationary pressures affect areas of the economy that cannot pivot as quickly as grocery prices. For example, but we will normalize regardless to that thereafter. The good news is that these elements are lower ranges than expected, so we may see things normalize sooner rather than later. As we look at longer term inflationary pressures, these are things that we may not consciously notice in our everyday lives, like we do with clothing or home prices, and the period for them is typically a decade or more. The positive in these factors is that they cause downward pressure as opposed to upward when we look at inflation. So we might want to know what are those types of long-term inflationary pressures. First, we have an aging demographic, which will eventually cause labor supply to shrink a little bit. A rise in automation and technological advances will possibly come of this, which can fill the gap in the workforce. Add that to globalization in the workforce with companies outsourcing jobs for lower wages. If that happens, wage inflation and other inflationary pressures would be contained a bit. Right now, we see an expected lack of job outsourcing resulting from the need of these jobs only done domestically, and because we have a large number of Americans still not working after the pandemic began. So, in summary, inflation is never a happy topic, but we do think that we will see some relief beginning next year. And while we don't think about outsourcing and aging workforce or automation, these factors are at play in the near term too. The effects just take a little bit longer to see. And for now, we'll just need to hang in there, everyone. Enjoy this beautiful weather as we get towards Thanksgiving Day. Please remember that anything mentioned today was not a recommendation. If you do have questions, you can reach us here at the office. But until then, we'll look forward to seeing you in the future. Have a wonderful week ahead.